The opportunity for testing occurs because my interpretation of financial markets directly contradicts the efficient market hypothesis, which has been the prevailing theory about financial markets. That theory claims that markets tend towards equilibrium. Deviations occur in a random fashion and can be attributed to extraneous shocks. If that theory is valid, mine is false, and vice versa. Let me state the two cardinal principles of my conceptual framework as it applies to the financial markets. First, market prices always distort the underlying fundamentals. The degree of distortions may vary from the negligible to the significant. This is in direct contradiction to the efficient market hypothesis, which maintains that market prices accurately reflect all the available information. Second, instead of playing a purely passive role in reflecting an underlying reality, financial markets also have an active role. They can affect the so-called fundamentals that they are supposed to reflect. There are various pathways by which the mispricing of financial assets can occur. The most widely traveled are those which involve the use of leverage, both debt and equity leveraging. The various feedback loops may give the impression that markets are often right, but the mechanism at work is very different from the one proposed by the prevailing paradigm. I claim that financial markets have ways of altering the fundamentals, and that may bring about a closer correspondence between market prices and the underlying fundamentals. Contrast that with the efficient market hypothesis, which claims that markets are always accurately reflecting reality and automatically tend towards equilibrium. My two propositions focus attention on the reflexive feedback loops that characterize financial markets. There are two kinds of feedback, negative and positive. Negative feedback is self-correcting. Positive feedback is self-reinforcing. Thus, negative feedback sets up a tendency towards equilibrium, while positive feedback produces dynamic disequilibrium. Positive feedback loops are more interesting because they can bring about big moves, both in market prices and in the underlying fundamentals. A positive feedback process that runs its full course is initially self-reinforcing, but eventually it is liable to reach a climax or reversal point, after which it becomes self-reinforcing in the opposite direction. But positive feedback processes don't necessarily run their full course. They may be aborted at any time by negative feedback.